On May 15, 2026, the Federal Reserve gets a new chairman. His plan is already on the record. To the United States Senate, his technical plan is to cut interest rates while inflation runs above interest rates, to shrink the Federal Reserve's balance sheet, and to rely on artificial intelligence to keep prices in check. His plan is not new. Something similar has been done before. Economists have a name for what this configuration produces. They call it financial repression. The last time it ran, between 1946 and 1974, it quietly transferred 3 to 4% of the entire American economy every year out of savings accounts and pension funds, from the middle class and the poor to the government, for nearly 30 years, without a tax, without a vote, without anyone calling it a name. In this episode of Money by Numbers, we expose how it worked then, and exactly how it is about to work again, because pension funds and savings are rigged against the middle class and the poor. By design. Low interest rates are reported as good news for the economy. Cheaper mortgages, more business investment. That framing is not wrong, but what that framing leaves out is who pays for the good news. John Maynard Keynes had a name for what savers experience when inflation runs above interest rates. He called it confiscation, secret and unobserved. The mechanism is built to be invisible. Keynes named that quality. The receipts confirm it. The mechanism has run before. The data is public. Over the next 12 minutes, the receipts will show you exactly how this mechanism works. The United States government has $39 trillion in national debt. The bigger problem is not the debt itself. It is the interest on the debt. The government has one source of revenue: your taxes. The fastest growing expense in the federal budget is not defense, not infrastructure, not research. It is the interest on what was already borrowed, over $1 trillion a year. More than the country spends on its military. More of your taxes, going not to a service, not to a school, not to your kids' future, but to pay back debt that was already spent. Out of every dollar you pay in federal tax, 14 cents now goes to interest. Before a single school is funded, before a single bridge is built, before any of your tax dollars do anything for you at all, that math creates pressure, not on a politician, not on a party, on the institution that decides what rate the government pays on its debt, the Federal Reserve. The lower the interest rate, the cheaper the debt is to service. And when the inflation rate runs higher than the interest rate, the debt becomes even cheaper for the government to pay back. Every administration faces this same choice. They can raise taxes to pay down the debt, but they don't, because raising taxes costs votes. They can cut spending, but cutting spending also costs votes. The silent alternative, the one that operates without announcement, is for the government to let inflation do the work. Quietly, on the people who hold cash. When inflation hits, no headline ever says, "We just raised your taxes." Because technically, they didn't. They just made your money worth less and paid down government debt at the same time. The political commitment was to pay this debt down. The structural pressure pointed somewhere else. The data shows which one won. The same combination that shrinks the debt, low interest rates, high inflation, has been used by the United States government before. The data is public. The receipts are documented. The United States does not pay its debt off. It inflates the debt away. The historical record proves it. The first well-documented case of the government using this scheme is in 1946. The United States emerged from World War II with a debt crisis. The government did not solve it by paying the debt down. It used the same mechanism we have just named. Here is what it cost. In 1946, the national debt was $271 billion. The economy itself, $222 billion. The country owed more than it produced in a year. A debt-to-economy ratio of 106%, the largest in American history at that time. 28 years later, 1974. The national debt had not gone down. It had gone up because the government kept borrowing to $475 billion. More owed in numbers, but numbers and value are two different things. Inflation had done some invisible work. Every dollar the government owed was now worth less than the dollar it had originally borrowed, so the same debt felt smaller than it actually was. That is how the government got out of its debt crisis, not by paying it back, by making the money worth less while it sat there. In 1946 dollars, the original debt was $271 billion. In 1974 dollars, that same debt would have been worth $686 billion. The actual reported debt in 1974 was $475 billion. Inflation alone had quietly wiped out more than 30% of what was originally owed, invisible to the public. Today, April 2026, the national debt is $39 trillion, according to the United States Treasury. The economy is just over $30 trillion. The country owes more than it earns in a year. By a lot. The debt is 124% of the size of the economy. That is higher than it was after World War II. America has never owed this much compared to what it earns. And the same configuration that got the country out of debt last time is about to run again. Here is how the mechanism works. The system pulls two levers, working together. First, the Federal Reserve holds interest rates below the rate of inflation. Then, the government boxes the institutions in: banks, pension funds, insurance companies, until they have no choice but to lend at losing rates. The system gets richer. Savers and pensioners get poorer. The wealth transfer runs automatically. In the late 1940s, the Federal Reserve held interest rates close to zero. Inflation, meanwhile, ran between 5 and 10%. Anyone holding cash at the bank or government bonds earned almost nothing. The cost of living rose anyway. Every year, the gap quietly took purchasing power out of every pension and savers account. How did the system get banks and pension funds to lend at losing rates? It made the alternatives worse. From 1942, the Federal Reserve formally agreed to hold interest rates on government bonds below the rate of inflation, at the Treasury's request. A regulation called Regulation Q capped what banks could pay depositors, keeping savings rates low by law. Insurance companies and pension funds were boxed in by capital rules that pushed them toward government bonds regardless of yield. 3 structural levers, all documented, all operating at the same time. The institutions were not forced. They were boxed in. The system rerouted billions of dollars of savings to the government at rates below inflation, year after year, for nearly 30 years, by design. The cost did not disappear. The system shifted it off the government's books onto the people who lent the government money through their pension funds, through their savings accounts, through every retirement plan in the country. 2% in interest, inflation at 6%. Every year, 4% of their savings gone, without a tax, without a vote, without ever being told it was happening. The International Monetary Fund measured what this transfer was worth. For the United States, 3 to 4% of the entire economy, every year, for nearly 30 years. Across the country, between 1946 and 1974, an entire generation of savers. Workers who had bought war bonds, families who had saved for retirement, pension funds that had promised payouts. Watch the buying power of those savings drain away. Not all at once, a few % a year. Economists Carmen Reinhart and Belen Zbrancia, in research published through the National Bureau of Economic Research, attribute roughly 30 to 40% of the entire post-war debt reduction to this mechanism alone. Not growth, not austerity, not paying it back. Financial repression, quiet enough that most never connected what they were losing to what the government was gaining. Here is what that meant for one household. Consider a steelworker in Pittsburgh who started saving for retirement in 1950. He put $1,000 a year into treasury bonds, did everything he was told, followed the rules. By 1974, he had paid in $25,000. The bonds had paid him interest, but the dollars he got back bought less at the grocery store than the dollars he had put in. Adjusted for inflation, his savings had lost more than a third of their value. He had not been robbed. He had not been taxed. He had simply held cash while the system ran. That is what financial repression cost the saver who did everything right. There is one key difference between the 1940s and now. Back then, the government locked in its borrowing for 10, 20, 30 years at a time. Today, most of the debt is short-term, 1 year, 2-year loans, rolled over constantly. The government does not have a 30-year mortgage on its debt. It has the equivalent of an adjustable rate mortgage on $39 trillion. When interest rates fall, the cost falls fast. In the 1940s, the mechanism took years to transmit. This time, every rate cut lands on $39 trillion of short-term debt the same quarter it is announced. The scale is larger. The speed is faster. The mechanism is the same. That is what the receipts show. The case almost stops here, because versions of this argument get made with ominous music and red string on a corkboard, attributing it to a deliberate conspiracy. That is not what the data shows. What the data shows is a structural problem with a structural solution, one that happens to cost savers and benefit the government. Not because anyone planned it that way, because that is how the mechanism works. The receipts do not require a conspiracy. They require a calculator. That is what the system did the last time. Now to what the system is about to do again. The new Federal Reserve Chair has stated his plan, out loud, on the record, to the Senate. 3 levers. The same 3 the system pulled the first time. First, the new chairman wants to cut interest rates. Here is why. Most of the $39 trillion is short-term debt, rolled over constantly. The lower the interest rate, the cheaper that debt is to carry. Less of your taxes going to interest payments. More room for the government to spend elsewhere. But there is a second reason, and it is the one that matters more. Inflation is running at about 3%. If interest rates fall below 3, the government borrows money for less than the cost of inflation. The saver loses ground every year holding cash. That is what financial repression does. By design. Right now, the Federal Reserve sets interest rates at around 3.75%. The new chairman has said he wants to bring them down by a full percentage point this year, to 2.75, with inflation running at 3. Interest rates below inflation. The first lever, engaged. Second, the new chairman wants to shrink the Federal Reserve's balance sheet. Here is what that means. When the government cannot borrow enough money from the public, the Federal Reserve steps in and lends money to the government instead. The Federal Reserve does not have that money. It prints it, then lends it. The total of all that printed money, sitting on the Federal Reserve's books, is $6.7 trillion. The new chairman wants to start selling some of it back into the market. The new chairman's bet: private buyers will step in to take the Federal Reserve's place. Banks, pension funds, foreign governments. Their demand will be strong enough to keep the system running. And if private demand is not enough, look at the historical record. From the 1940s through the 70s, when the same problem appeared, the government solution was new laws, new regulations, quietly compelling banks and pension funds to keep buying. The institutions were not forced. They were boxed in. If private demand is not enough this time, that is the same playbook waiting on the shelf. Third, the new chairman says artificial intelligence will keep inflation in check while interest rates are being cut. The argument: AI will make businesses more productive, drive costs down, and prevent the inflation that low interest rates would otherwise cause. There is a problem with this argument. Productivity gains in America have a track record, according to the Bureau of Labor Statistics. Since 1973, productivity has grown about 75%. Worker pay has grown about 12%. The gains went somewhere. They did not go to the people producing them. They went to the people who owned the businesses. If AI is the next productivity wave, there is no reason to expect anything different. The system has shown which side it pays. 3 levers: cut interest rates below inflation, shrink the balance sheet, and lean on private buyers or new regulations if private buyers do not show up. Tell the public that AI will absorb the inflation. Each lever, on its own, sounds like sensible monetary policy. Put them together, and you have the same 3 levers the system pulled from 1946 to 1974. Quietly, over 30 years, inflation running above interest rates, every year, until the real value of what savers were owed had shrunk by more than 30%. The debt got cheaper, the savings got smaller. At the same time, by the same mechanism. There is an argument for all of this. The argument goes like this: low interest rates support the economy. They make mortgages cheaper. They give businesses room to invest. They keep employment high. What looks like a transfer from savers to the government is actually just the price of a healthy economy. The argument is not wrong. Cheap mortgages do happen. Businesses do invest. Employment does stay high. But the argument leaves out one thing. It does not say who pays for it. The cheap mortgage on one street is paid for by the shrinking pension on another. The stimulus that lifts asset prices for the wealthy is paid for by the saver whose dollars buy less every year. The argument is not that nothing good comes from low interest rates. The argument is that the good is unevenly distributed. By design. This is what financial repression looks like. The government keeps interest rates below inflation. Inflation eats away at the dollars sitting in savings accounts and pension funds. Those same dollars, owned by the government as debt, get cheaper to pay back. The savers lose. The government wins. Quietly, without a tax, without a vote. The people who pay are the people who hold cash. Pensioners, savers, anyone with money in a bank account, the middle class and the poor. The people who benefit are the government, and the people who hold assets, houses, stocks, businesses, things that rise in value when the dollar loses value. The wealthy. Same mechanism. 3 different effects. The math runs every day, in every paycheck, every grocery bill, every retirement statement. In the same year, the saver in Pittsburgh loses 1/3 of his retirement to inflation. The asset holder watches his house, his stocks, his business, all rise. The same dollar, 2 different stories, depending on who held it. The last time the system did this, Between 1946 and 1974, it took more than 30% of the country's original debt out of savers' pockets, quietly, over 30 years, without anyone naming it, without anyone voting for it, without anyone calling it a tax. On May 15, 2026, the Federal Reserve gets a new chairman. The plan is on the record. The same mechanism, the same 3 levers, the same audience, paying. The debt does get paid down. The only question this system has ever asked is by whom? Now you know the answer. Pension funds and savings are rigged against the middle class and the poor. By design. Finance told through data. Money by numbers. Money by numbers exposes how the system is actually rigged. No courses, no newsletter, no portfolio to sell you. If that is what you want from a personal finance channel, subscribe. The next case file drops next week.